This week, this week's topic is super exciting for me. It's my favorite. It's credit. Credit and debt. DEBT, debt. So what's credit? What do you think?
Money that is borrowed that you get to borrow, but you have to pay back.
Yeah,
So, so yeah.
yeah, Ramani, great. Technically, yeah, the textbook definition of credit is the ability to acquire something now, but pay for it later. So when you buy something on credit, you essentially buy that on borrowed time. You're borrowing future earnings that you will have so that you can have something now. And in order, whenever you use credit like that, you're going to pay interest. So just like last week, when we learned about savings and there's interest that's paid there. So in other words, last week, say we had $100 and we deposit that at the bank in a savings account, the interest that we would earn might be expressed like 3%. So if we leave that $100 in a bank or credit union at 3%, we will get $3 per year on $100. Now, your loan from that very same bank is expressed as an interest rate as well. And so instead of being paid $3 if the interest rate were 3% and we borrowed $100, we would then be charged that $3. Hopefully that makes sense. So interest can work both ways. If you're saving money and the bank is paying you interest, then you are earning interest. However, if you're borrowing money and you're using credit, then you're paying interest. You're being charged interest. So good. Ramani, thank you. That's a good explanation of credit. So let's get into the presentation this week from JA. So remember, we're using JA's personal finance curriculum. JA, again, is junior achievement. And I'm going to hit play. And that was fast. Sorry. That was the last slide. So let me go back to the first. I was practicing earlier. Here's the first. Credit and debt. Okay. Arshan, Ramani, and Imani. True or false? There's no such thing as good debt.
True.
False.
Imani, do you have a tiebreaker?
Said false.
There's no such thing as good debt. False. That's right. Some debt can be good if it is worth more than what you pay for it.
Oh, I thought debt means like behind.
Good. Yeah, it does. It does. But this is part of the whole lesson for tonight. Debt means when you take on debt, you are borrowing money that you have to pay back, right? That's debt. But what this is telling us is that some debt can be good if it is worth more than what you pay for it. So for example, a low interest student loan to pay for college or a trade school can pave the way to higher earnings. You might eventually earn more money than you spent on the loan. Does that make sense? What do you think of that?
Yeah, that makes sense.
So what this is saying, and again, this is we'll assume this is not a Kalamazoo Promise world. So imagine taking on student debt. So like, how much do you think it costs? Let's say $20,000 a year, just to keep the math simple. So say it costs $20,000 a year to go to college, and we don't have any money. So we might have to take on debt or take out a loan. That's the same thing, debt and loan, same thing. So if we have to take on debt for $20,000 per year, that's going to probably cost us, I don't know, $1,000 per year. So I'm going to have to pay back $21,000 every year. But if that degree that I eventually get enables me to earn more money than what I make now, it allows me to have a better job and more income. That's an example where taking on some debt can be good if it's worth more than what you pay for it. So Arshan, you initially said true to this. What do you think now after hearing that explanation?
It makes sense now. Like, I get what you mean. Like, if
So
you get for a better like option, I guess you could say, and yeah, it's better for you, and it's good debt because it's not like you debt for no reason.
yeah, exactly. So going into debt for no reason would be like, say you've got a credit card, right? And it's 6:45 on a Tuesday, and I'm just really hungry. I have a whole bunch of food in the fridge, but I have to cook all of it. But I don't have any money either. So I take my credit card and I go to Taco Bell and I take on $20 worth of debt for tacos. Now that's senseless because, right, I could have just made that at home, but also I'm taking on debt. And for those tacos, I'm going to end up paying a lot more than just $20 because I'm going to be charged interest too. So that's an example where those tacos are not going to give me a good return for taking on that debt. They're going to fill me up for, maybe the rest of the night, but I'm going to be paying for it for weeks. Another example of a potential good debt would be a house, right? So most of us in this country take on debt in the form of a loan or a mortgage to buy a house, because a house, say the average house in Kalamazoo might be between $100,000 and $150,000. Most of us don't have that in the bank, and most of us are not able to pay $100,000 in cash. So most of us will go to a bank or a credit union to take on debt and borrow that money. Now, the reason that may be considered a good financial move is because historically, homes, for the most part, increase in value over time. So most homes that you take out a mortgage on, you're going to take out a mortgage for 30 years. Most homes over 30 years are going to be worth more then than they are now. So that's an example where a mortgage for a house can also be an example of good debt. Does that make sense?
You just said it would be worth more then than it is now.
Yeah.
Why?
Yeah, and that's what I meant. Yeah. So Imani, thank you. So if I bought a house today in 2022, right, for $100,000, I take out a loan for $100,000 and it's worth $100,000. I'm probably going to pay that off by 2052, so 30 years. Hopefully, in 30 years, that house is going to be worth a lot more than $100,000. So hopefully, in 30 years, that house might be worth $500,000. And that's an example where, even though I had to take on debt and pay interest in order to buy that asset, it's going to be worth more long term.
Okay, so I think I just got confused because I think I heard you say it backwards, but that makes more sense.
And Monty, I probably said it backwards. So yeah, but in general, when we buy houses, when people buy houses, they expect the price to go up. And in general, if you wait long enough, it does. Now there are, cycles and dips in the market, but over time, the price of houses generally goes up. Now, what about a car loan? Oh, there's a chat. Oh, getting the food. Car loan. A lot of people also take on debt to buy a car. So that's an example where that can be good debt or bad debt, depending on what you're using the car for and what type of car you bought. So if you need to take on debt in order to buy a car, in order to get to work or school, which many of us, that's what we use our car for, that's probably taking on good debt, because you need transportation in the long run. Say you live further away than a bus route can take you. Sometimes taking on debt to buy a car might be a good financial decision, especially if you buy a sensibly priced car, right? You don't go crazy like a Honda Civic, or a fuel efficient, inexpensive car. However, say you bought a fancy car, a sports car, or a Lamborghini, taking on that kind of debt would not be a good financial decision, because cars, for the most part, do not hold their value. Cars, for the most part, lose their value, unless it's a luxury car or a historic car, right? Then it'll gain value. But I wouldn't buy what do I have? A Chevy Equinox. I wouldn't buy a Chevy Equinox as an investment, thinking that the price is going to go up. I would buy a Chevy Equinox as transportation, so that I can get to and from my job to earn money, enough money to pay off that debt. So that's how a car loan could be an example of good debt or bad debt. Okay. Moving on. After completing the session, we will be able to differentiate between credit and debt. What's the difference? We will be able to recognize the factors that affect our individual credit score and our credit history, and we'll recognize the consequences of a low credit score. And we'll also recognize the impacts of sharing credit cards or co-signing for a loan. So one theme that I'm actually really impressed with JA's personal financial literacy curriculum is that every section talks about managing this with someone else. So in other words, every section talks about how might you manage or navigate budgeting, saving, or in this case, credit, with someone else, a partner, a parent, etc. Most likely a partner. Okay. So now we're going to do some definitions. Here's the official definition of credit. Credit, the ability to buy goods or services now, but pay later. And remember, so you can use your credit to buy goods, so things like cars, homes, or services now. So you can use your credit to buy someone to mow your lawn, vacations, etc. Debt is money owed. So in this case, here's the difference. So credit is the ability to buy goods or services. Debt is the amount that you actually owe. So you have no debt if you simply have the ability to buy goods. If you use the ability to buy goods and pay for it later, now you have debt. And remember, even though debt sounds negative and it has negative connotations. We just learned that not all debt is bad, especially debt used for an asset like a degree or a house. Interest is payment for the use of money. That's kind of a wonky definition, so let's add to it. A fee paid to use someone else's money, or money earned from allowing someone else to use your money. I like that. So let's start with the first one, or the middle one. Interest is a fee paid to use someone else's money. Whose money are you using if you use credit?
The bank?
Yes, exactly. Exactly. So when you borrow, say, $100,000 to buy that house, you are paying interest in the form of a fee in order to use the bank's money. Now flip that around. When you deposit $100, or let's say when you deposit $100,000, the bank will pay you interest. So in other words, the last part of this, money earned from allowing someone else to use your money. So when you have $100,000 or $100, the bank pays you to use your money. Does that make sense? What is the bank doing with your money? Why do they want to pay you for your money? What do you think?
Can you ask that question one more time so I can understand it?
Sure. So when you put your money in a bank or a credit union, any financial institution, they pay you interest for you allowing them to use your money. What does the bank or the credit union use your money for?
To build interest, I think.
I think you're right. This is the whole business model, Raymani. They use that money to lend out to other people. So in other words, Raymani, say you have $100,000 and you want to put that in the bank to earn money. So you put $100,000 in my bank. I will pay you 3% per year as a way to say thank you for putting that money into my bank and allowing me to use it. So for that 3% every year, you're going to earn $3,000, right? Now, Arshawn comes into the bank and says, hey, I need to borrow $100,000. Okay, so I will check Arshawn's credit, which is what we'll talk about, and then I will agree to lend Arshawn $100,000. He will then pay me interest to use someone else's money. So he's technically using the bank's money to buy his house, but I got that money, the bank got that money from Raymani. And I'm paying Raymani 3%, me the bank. I'm paying Raymani $3,000 per year in interest so that I can turn around to Arshawn and give him that same money so that he can buy a house. Now, do you think I'm going to charge Arshawn more or less than the 3%?
More?
Exactly. I'm going to charge Arshawn more to borrow it. So Raymani, I'm paying you $3,000 a year, but I'm going to charge Arshawn 6% or $6,000 per year. And then so when he pays that, I'm going to make a profit, right? And that profit that I make is what I use to run the bank. Keep the lights on, pay the people, all the things. That's the whole business model of banks and credit unions. They pay you interest for the privilege of using your money, and then they charge other people more interest also for the privilege of using that same money. And that's the business model of a bank. Okay. What are some benefits of credit? What do you think?
It builds your credit score to and the better your credit score is, the better it is to like loan. I think that's the word. But yeah, I think
Yeah. So credit allows you, the better your credit score, the cheaper it is to borrow money, right? Let's see what this says. So under what are the benefits of credit? Well, it allows you to make large purchases that are difficult to save for, like the two biggies that we talked about, buying a house and paying for education. So buying a house is probably the largest purchase that many of us will make, other than maybe a business. And it would be rare, right, that we would have like $100,000 saved up. So when we use credit, it allows us to make a large purchase that's difficult to save for. It's convenient. It's safer to carry than cash. So right there, they're talking specifically about a credit card. It's good to have in the case of an emergency, credit. And then using credit helps build credit history. So those are some of the benefits of credit. What are some of the risks or negatives of credit? What do you think?
Using too much of it, you will just get used to using it, and then you don't pay it back on time, or you have too much to pay back, and now you're in the same position because you didn't have the money to begin with.
Yeah, exactly. So our presentation says officially, some of the risks of credit are that it makes it easier to make impulse purchases, right? So sometimes it makes it too convenient. You get used to it, Imani, like you just said. It's easy to buy more than you can afford with credit. Sometimes the terms and conditions of credit are complicated. So like if you've seen advertisements for like 0% interest when you buy something for 18 months, those are terms and conditions. So the terms are 0% interest for 18 months, but the conditions might state that you start earning interest on day one that you use that credit. That's an example. And then purchases can end up costing more if they're not paid off in time. So, you know, even using credit in a good way, like to buy a house, things are going to cost a lot more over time. So that $100,000 house over 30 years, you'll probably pay $250,000 for, but you'll have a house. Any questions about some of the benefits or risks of credit?
no. But can you have this stay on just for a couple seconds on
Yeah.
writing?
Of course. And have you all been able to log in to JA?
No.
All right. Arshan, do you have the logins for people? That was supposed to come from Laura.
Yeah, I never got them.
Okay. The reason I bring that up, Raymani, is there's like a cool 1-page PDF, like it's a recap of everything that we're talking about. Just let me know when you're ready to go.
I'm ready.
All right. Okay, credit history, credit score. Have you checked your credit score? How about a yes or a no? And don't tell me what it is. Arshan, yes, you've checked your credit score. Imani?
No, I'm not sure how, because I have a secure credit card. So I'm not even sure how yeah, but I'm figuring it out.
Well, I'll tell you. Well, yeah, it's okay. Imani, how about you?
Can you repeat the question? I'm sorry.
Have you checked your credit score ever or your credit history?
Oh yeah, I got my credit card. They sent me a credit card in the mail right before I went to college, and I just
Nice.
used it ever since. So yeah, I check my credit score quite often, and especially since I moved out, I check it a lot because they have to check it.
Nice. How do you check it?
I use Credit Karma,
Yeah.
because I see all the commercials, and it so far I haven't had any issues because I can do my taxes through there too. And then I usually, like when we were moving, they would send you, they would do a hard credit check, and they would send you like the Experian, and I can't remember the other one. So I would see it through there too.
Nice. Okay.
Is that the link that, not the link, but the website to check your score for secure credit cards?
Yeah. So let's talk about that a second, Raymani. So there are 3 credit companies or credit bureaus. Bureau is a fancy word for company. There are 3 credit companies in our country that keep track of our credit scores and our credit history. They are TransUnion, Equifax, and Experian. You don't need to memorize that necessarily, but if you hear that, know that that's one of the 3 credit bureaus. When they maintain your credit, this is a perfect time. Let's define credit history. Each of the 3 bureaus maintain your credit history, which is a record of your personal financial transactions. So my credit history is, while it's different, Raymani, than your credit history, they're all maintained by those 3 credit bureaus. So the record of who I've ever borrowed money from and how well I've paid that back, that's my credit history. That's with those 3 credit bureaus. And Raymani, that's the same if I use a secured credit card, if I have a mortgage, if I have a Kohl's card, if I have a student loan, if I have a car loan. Everyone who I owe money to in the United States will be on my credit history. So in other words, there's no special credit score or history or report to pull because you have a secured card. We all have the same places to pull our score from. Does that make sense, Raymani?
Yes, it does.
So Imani mentioned Credit Karma. Credit Karma, you've probably seen commercials for it. It's an app and a website, I think, but an app for sure that you can go on. You share some of your personal information, and it does what we call a soft credit pull. So
Yeah.
Imani, yeah. So
I had tried Credit Karma and Credit Sesame, but I wasn't sure if it would, like, when I pay off my credit, will it automatically like calculate that and put that like in data on the app, or like do I have to connect my bank to it? That's why I was like confused because I wasn't sure.
those are great questions. That's why we're here. Yep. So the answer is there's nothing you would have to do other than pay off your debt. So it's up to not Credit Karma, but those 3 credit bureaus, TransUnion, Equifax, and Experian. It's up to them to keep track of who you owe, how much you owe, and whether or not you paid on time. All Credit Karma does is access those reports and display them to you in a way that is easy to understand and free. Credit Karma will usually display a higher credit score than like when you go to a bank or a credit union. It's just the way it works. To get the most accurate credit history, I did type in annualcreditreport.com there. That's the one that we as bankers recommend. We don't officially recommend Credit Karma, but we say, you know, as long it's cool that you're interested in your credit score. So great, keep on using it. Oh, go ahead.
Well, thank you for the credit thing.
Yeah, if you go to annualcreditreport.com, this is run by our government, and you can get one free report per credit bureau per year.
Okay.
So remember, there are 3 credit bureaus, so you could technically get 3 reports per year.
Okay.
And again, so the report, your credit report, contains the history, which is a record of your personal financial transactions, as well as your score. Your score is just a number representation of your history. So again, your credit score is just a number representation of how well you've paid people back. If you've paid people back on time, all the time, and as much as agreed to, you're going to have a high credit score. If you've missed some payments, or you've had some late payments, or you didn't pay someone entirely, you're going to have a lower credit score. And it's as simple as that. Now, what your credit score actually is, whether it's a 650 or a 720, that's going to depend on a lot of different factors, including how much you owe versus how much your limit is, if you've ever missed a payment, things like that. This is a video. We know that we can't. Okay. So I'll pause there. Any questions so far about credit?
Nope.
Okay. Thanks. You've asked really good questions so far, so thank you. This is a great slide. Who cares about your credit? Well, these companies do, and we've probably run into some of that in our lives. Insurance companies care about your credit. So if you've got a high credit score, you pay less for your insurance, your car insurance, your homeowner's insurance, your renter's insurance. If you have a high credit score, those are cheaper. If you have a low credit score, those are more expensive. How come? Why is that? Why do you think that is? I'll give you my answer. For better or for worse, insurance companies use your credit score as a determination of how trustworthy you are. So it's about risk. Insurance companies think that if we as consumers have a low credit score, that means that in the past, we've either taken on too much debt or we haven't paid back our debt as agreed to. Either we haven't paid it back at all, or we've paid it back slower than it should be. That means that for those insurance companies, they view me as a bigger risk than someone who pays on time. And that's true of utility companies too, like gas, water, cell phone companies are notorious, right, for checking our credit. Landlords use credit reports to screen people. So and it's all about risk. So the landlord wants to know on the first of the month, how likely is it that I will be paid? If someone has a high credit score, that chance is closer to 100%. If someone has a low credit score, the landlord could draw the conclusion that I won't pay on time. And then finally, employers. So many companies review your credit before offering you a job. Now, is this fair? I personally, as a citizen, would argue, no, that's not fair. A lot of this isn't fair, but that is the world we live in. So it's important that we educate ourselves about how to use credit so that we can, again, this is all about financial literacy and empowerment, so that we can use this to our advantage. And most importantly, so that we don't get taken advantage of by the people on this screen. Any questions about this?
Nope.
Cool, pretty straightforward. Oh, I like this. Okay, so this is interactive. You help me decide whether each statement is a healthy credit tip or a common credit mistake. And we'll drag it to that image. Keep the same accounts open for several years. Do you think that's a healthy credit tip or a credit mistake?
Healthy?
Raymani and Imani say healthy. Yes. Keep the same accounts open for several years. Yes. So again, remember, credit, it's all about risk and trustworthiness, right? So when you go to a bank or credit union, they don't know who we are. They only know us as our credit score. And our credit score is how trustworthy and how much of a risk are we? If we've had an account open for 10 years, that tells whoever we're trying to borrow money from that, hey, we're pretty consistent. Like we can handle having credit open. We've had relationships that have worked in the past. That's literally what that tells someone. Okay, instead of using credit cards, use payday or installment loans. Credit mistake or healthy tip?
Credit mistake.
Credit mistake, correct. Do not use payday or installment loans. What's a payday loan?
I just know they bad. That's
They
really
are.
the only thing that I know.
Is it like
money?
the money for, I don't know, you know what? No, I'm not even gonna say that.
It's the money
Yeah, I don't
that
know
you
what
make
payday
that day, and then you use it, and you have to pay it back when you get paid.
Yep. Yeah, it's a short-term loan. It's a super short-term loan. There are a lot of payday lenders in our city. There's less now than when I was a kid, but like the Cash Advance store, I'm not to, I'll just call them out by name, the Cash store, places like that, where you go in and you can get a very short-term loan, like a payday loan. So today's Tuesday and my payday's Friday. Say I needed, I could go into the Cash Advance store and I bring in like a pay stub and they confirm that I do in fact work, and they figure out how much I usually make. And so they'll know that I've got a check coming for like, we'll say $300 on Friday, right? So they'll say, Joe, I can lend you $300 today, excuse me, $200 today, but on Friday, I'm going to take that whole check. Okay, so you'll have $200 today, but when you get paid $300 on Friday, I'm going to take all of that. So that $100 is the interest I'm going to charge you for the convenience of getting your money early. Now, the math there is not correct. It's not really that extreme, but it's bad. And then so what happens is I get to Friday and I use my whole check goes to the Cash Advance store, but then it's next Tuesday, and next Tuesday I'm in the same situation and I don't have enough money to make it to payday. So I'm forced again to go back to the Cash Advance store. And that's how I end up getting in this cycle of debt. And a traditional interest rate on a credit card might be like 15%. So for every $100 I borrow per year, I pay back $15. That might be reasonable. But an interest rate at a payday advance store can be in the hundreds. It can be 200 or 300%. So for that same $100 that I borrow in a year, I would pay $300 back. So again, this is about what we're doing tonight. This is financial literacy and financial empowerment. So being financially literate is being able to understand that that is a bad deal. You are being taken advantage of when you do business with those types of places. But they try to trick you, they try to trick us with marketing and trying to really lean into that you want cash now feeling. What do you think? Does that make sense about the cash advance stores, the payday stores?
Yeah.
Okay. What about paying your bills on time? Is that a mistake or a healthy tip?
A healthy tip.
Yeah. Not only is it a healthy tip, it's the most healthy tip. So the number one thing you can do to either increase or maintain your credit score is to pay your bills on time. Your minimum payment, that's what we're talking about. Pay it on time. The number one thing you can do to lower your credit score is miss a payment. Okay, always read the fine print on credit cards, yes or no? Arshawn says yes. Yeah, for sure. Again, that's part of being financially literate and doing business with a reputable company too. Keep what you owe less than the maximum. Good or bad? Arshawn says good. Yes. And so what that means is think about a credit card. When you get a credit card, a line of credit, it always has a limit. Say it's like $500. That would be a pretty common first credit card that you get. You have a limit of $500. That means if you tried to spend $501, you would be over your limit. Sometimes it will let you do that. When you do that and you go over your limit, that's a very negative thing on your credit report. So always keep what you owe less than the maximum. So even though I can owe $500, I'm going to try to keep it $300 or less. Pay the minimum on credit card each month, good or bad?
Good. No, bad. No. What do they mean by minimum?
Great. Yeah. So good in that, hey, yes, you're at least paying your bills on time, right?
Mm-hmm.
However, bad that you're only paying the minimum. So let's go back to that credit card example. I have a credit card with a $500 limit. I owe nothing on it today. I'm going to go buy $400 worth of groceries. Easy to do, right? When that bill comes next month and I've charged $400 at like Meijer, right? I owe $405 to pay it off. But the minimum payment, it's going to say, Joe, you only need to pay us $25.
Yeah, that's what mine said. Mine is like you only needs to pay $35. So yeah, so that's what I've been doing. So it's not good. It's good to just pay it all on that day.
Yeah, so Rimani, it's best to pay it all down to zero. When you pay your credit cards down to zero, you don't pay any interest.
Okay.
So that is the best and most responsible way to use a credit card, is to use it. And then when the bill comes, you pay it all the way off. That way you never pay any interest, but you're still getting the benefit of building your credit. Because when you make that payment every month, that's what's building your credit. Now that said, I don't want you to feel bad. It's not the end of the world that you're only making the minimum. It's just going to take you longer to pay off that credit card. So in that example of the $400, it might say, Joe, your minimum payment is $25. If I sent in $25 every month, it might take me, I don't know, 2 years to pay off that $400. And instead of $400 for groceries, I might end up having paid $600. which is crazy unless it's an emergency. If it's an emergency, then my credit has done its job, right? I've paid more than the groceries cost, but me and my family didn't starve for the period that I had to do that. So that's an example of using credit responsibly in an emergency. But so Rimani, if you're just paying the minimum on your credit card each month, you're satisfying your credit score, so that's good, but it's going to take you a lot longer to pay off your card, and you're going to end up paying more. Does that make sense?
Yes, that makes a lot of sense. Now I know to pay it all.
Yeah, if you can. I mean, you know, part of budgeting is being realistic with yourself. There's going to be months where it's just not possible, but yeah, paying the minimum. So that would be a mistake. Let's see. I'm gonna skip ahead just to make sure we finish because we got less than 10 minutes left here. Using your credit regularly, I would say that's a healthy tip. Yeah. Use student loans to pay for tuition and all your living expenses since it's low interest. Well, I think you should use student loans to pay for tuition, but I don't think living expenses. Yeah. And then check your credit regularly. Good. All right, let's move on here. We're gonna do that all day. Okay. Is this person a good credit risk? Let's read about her. I got my first credit card 1 year ago and maxed it out. What does that mean? What does max it out mean?
Spent like all the money on it, right? Or like all
Yeah.
the money you could.
Yeah. So say she had a credit limit of $500. If she spent $500, she has maxed it out. Okay. I got my first credit card 1 year ago and maxed it out. I've been making the minimum payment every month, but I've been a little late a couple times. I just got a second credit card for emergencies and I haven't used it yet. I'm nervous about my credit report, so I haven't requested to see it yet. Oh, well, where's the answer? Oh, there's no answer. Okay, well then we'll just decide if she's a good credit risk. What do you think of this first person? First credit card a year ago, maxed it out. She's been making the minimum, but she's been late a couple times. Just got a second card for emergencies. Doesn't check her credit. Is she a good credit risk?
No.
How come?
Yeah, credit risk, yeah. Well, credit risk is a bad thing, like you're risking your credit, right?
Well, like, so Raimani, you are the banker here.
Uh-huh.
She's come in to ask you to borrow some money, and this is her story. This is how she's handled her credit in the past. You, as the bank, do business with her.
Mm-hmm.
Yes?
No.
I see Arshawn wagging a finger. How come, Arshawn?
Completely untrustworthy.
Completely untrustworthy.
Yeah, she's missing a couple payments and she's maxing it out, spending too much of the percentage she was supposed to spend. So they're not gonna trust her. They're not gonna think that she's responsible.
Mm. Yeah. But what if she's a single mom and was using that credit card to feed her kids?
True.
She should have added that in her story. Would have made it better.
You think
Or
the
the same
bank would?
deal.
Do you think the bank would care?
No, it's
Uh-uh.
she should like if she's doing it for food, she should like have like a certain percentage of like how much she want to spend just on food and then pay that off. Or like if she like has a job and stuff like that, she can like just use her paycheck as the food and yeah.
Yeah. Yeah, good solution. So if she came to me as a banker, I would say let's make sure that you check your credit report twice a year at least. Even if you're scared or nervous to do it, that's not a good excuse to not do it, you know? Like, I'm scared and nervous to step on the scale, right? And see how much I weigh, but I gotta do it. Same thing with credit. So you can't hide from a credit problem. She maxed it out. That's, that happens. The fact that she's been late a couple of times probably lowered her credit score a little bit. So I think it's important that she check her credit. So is she a good credit risk? I would say as a banker, she's not ideal, but I would try to educate her to pull her credit at least twice a year, and then she's probably an okay credit risk. Okay, this person. I recently finished college with $15,000 in student loan debt and started working. I make enough money to cover my loan payments and basic expenses, but I've been late with my loan payment a couple times. I'm thinking about getting a credit card to free up some spending money in my budget. What do you think?
Yeah. Like he cool, right?
I like everything that's going on here. At $15,000 in student loan debt in today's world, that's like nothing, right? Makes enough money. The only thing I don't, he's missed a couple loan payments, which happens to us. The only thing I don't love is that he's getting the credit card specifically for spending money.
Yeah, that's what I was looking like, the credit card, because then he's gonna have to pay the credit card, trying to pay the loan, so that just don't make sense.
Yeah. So like everything adds up except the last part. Good call. The last part sounds like he probably just needs to budget better and make some different priorities. And I would get the credit card as an emergency. That's what I would do. Maybe his loans are paid off. Well, yeah, except for the student loan. We know he still has that one. His loans are definitely, I don't think they're paid off because he's making payments on them, but they're definitely under control. Okay, let's do one more. Uh-oh, I see Disneyland. That's the first word I saw. Okay, I just got my first credit card and used it to go to Disneyland. I won't be able to pay it off all at once, but I think it's worth paying the monthly interest and fees to have a vacation. If I can't pay the monthly interest, I'll just pay what I can and let the interest add up. What do we think?
No. 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 That's bad.
Yep. Yep, that's bad. So why do people still do this?
Because I wouldn't say free money. I'll say that it's easy money. You're not working for the money. You're given the money, but it's not exactly like your money. It's still like money that it's like borrowing, but when you get that, it's like you not borrowing, it's like keeping it. But it's borrowing money and they don't see it as that. So it's like, oh yeah, I just borrowed money from the bank and I just spend it all, and
Yeah.
I have to pay them back. It's just like, oh, it's just free money, easy money.
Yeah, like I think money or credit can be tempting, right? So this is where financial psychology comes in, and we talk every week about financial psychology. It's in your head. It's all in your head, right? It's all about discipline and having a plan. So this is where credit can be a very powerful tool for people if it's used correctly and responsibly, but it can also be a tool to get in debt and keep us in debt, depending on how we use it. So hopefully what you took from this week is that, there is such a thing as good debt. Like debt and credit are both powerful financial tools, but the famous line, with great power comes great responsibility, right? It's like you have the power to buy all this stuff, the true power is not using it and only using it on what is really going to benefit you the most in the future. And that's going to be things that gain in value over time, like your education and a house. Does that make sense?
Yes, it does.
Credit. So we talked a lot about credit today. So Raymani, I hope you go out to annualcreditreport.com and check out your credit history and what's going on there.
Yes, I will. And now I know to pay my credit all at once and not just the minimum, because
If you can.
yeah, if I can. So yeah.
Yes. Imani, Arshan, do you have any questions about credit?
No, not really.
Mm-mm.
Okay. Cool. All right. Well, that's one of my very favorites. Thanks for your time and your attention. And Mike will be here next week, and then I'll see you the week after.
All right.
All right. Have a good night.
Yep, you
Yeah,
too.
good night.
Bye.